What's up guys, it's Justin, and I'm going to preface this video by letting you know that it's not going to be the most interesting thing that you watch today. If you hopped on YouTube solely to be entertained and my video popped up next to a Mr. Beast video, well, I'm not sure what you're doing here, but hey, thanks for watching. Taxes are boring, dry, and generally hated by almost everyone. That means that talking about them isn't exactly the most thrilling thing ever, but sometimes you have to go through the dry topics to get to the good stuff. And who says that taxes can't be fun? If you're going to fight through thousands of pages of federal tax code, why not add explosions, or sharks, or zombies to spice things up? I can't think of anything that goes better together than cinematic warfare and income tax brackets. Unfortunately, we tend to avoid the things that scare us, confuse us, or just don't interest us. And for a lot of people, taxes fall into all three of those categories. The result is that many Americans just don't understand how taxes work. And since many of us pay more than 20% of our income to the government, that's a problem. Even just a few minutes of educating could prevent you from giving too much money to the government, or getting into trouble with the IRS, or standing over your W-4 at your new job with no idea what to write down. So here are 3 tax concepts that people seem to get really confused by. If you're an expert in taxes already, congrats, you're ahead of the game. But if you aren't, sticking around for just the next few minutes could help you down the road tremendously. And first, I'd really appreciate you taxing the like button on this video. What does that even mean? Subscribing, leaving a comment about what types of videos you guys want to see in the future, telling your friends to come check out the channel, all of that helps me out a ton, so thank you in advance. All right. Let's get into it. Number 1 is income tax brackets. Now, it seems like a pretty straightforward concept, but there's a really bad misconception out there that a lot of people on the internet seem to have fallen victim to. Let's say our friend Jeff is a really successful executive at his company and he makes $160,000 a year. Good for Jeff. He's a good-looking dude, but he doesn't have a lot of game, so he's currently single. It's okay. We've all been there, Jeff. Well, if we look at our tax bracket table, making $160,000 a year as a single filer is going to put him right at the top of the 24% tax bracket. Jeff gets called into his boss's office one day, and lo and behold, all of that work he's been putting in is finally paying off because he's getting a raise from $160,000 to $170,000. Great news, right? Well, Jeff whips out a calculator, runs a few numbers, and then looks at his boss and politely declines the raise. When his boss asks why, Jeff explains that he's in the 24% tax bracket right now, meaning he only pays 24% of his income to taxes and he gets to keep $121,600. But if he bumped up to $170,000, that would put him in the 32% tax bracket, meaning he'd have to give away 32% of his money to taxes and would only get to keep $115,600. Jeff's boss decides that he's an idiot and fires him. But it all ends well for Jeff, because with all the free time that he gets from leaving the company, he was able to pursue a relationship, and he's now happily married with 3 kids. So where did Jeff go wrong? Well, what he failed to understand is that federal income tax is determined by marginal tax brackets, where the marginal tax rate is the rate of tax income on each additional dollar earned. So instead of getting taxed 32% on all of his income, he'd only be taxed on the money above $164,926, meaning he definitely should have taken the raise. These tax brackets are progressive, meaning the more money you earn, the higher rate at which those additional dollars are taxed. But the money left in those lower tax brackets remains completely unaffected. Money earned between $86,376 and $164,925 is always going to be taxed at the 24% rate, and that's never going to change. The second thing that people really struggle with is federal withholdings. Remember that W-4 I mentioned earlier? Well, that's the form that essentially tells your employer how much you want taken out of your paycheck for federal taxes. And instead of telling you what to put on there, since that's going to vary on a case-to-case basis, I'm going to explain what that actually means. You probably think of federal taxes as something that your employer just takes out of your paycheck. Not necessarily true. In reality, you're paying taxes on your taxable income minus deductions, and you can control how much gets taken out by your employer through your W-4. You see, obviously you have to pay taxes on the income that you earn. That's a given. But in reality, that money being taken out of your paycheck is just you prepaying a tax bill that isn't due until April. If you make a certain amount of money in a year, you take out the standard deduction and you owe a certain amount of taxes in a year, whether that comes directly out of your paycheck or you pay it yourself. And you may think that overpaying from your paycheck isn't a big deal since you'll get a refund anyway, but if you have too much money taken out of your paycheck, you're essentially lending the government your money for free. Unfortunately, you can't just not give the government anything and then pay it all at the end of the year. That would be awesome, but it's not legal, so don't do it. Figure out what your total tax bill should look like at the end of the year and adjust accordingly. And the third thing that so many people seem to get confused by is capital gains tax. Now, if you're a smart person, which I'm assuming you are since you're watching this video, you don't have all your money in a savings account, you have some of your money invested. Ideally, those investments make you money. And when those investments make you money, just like everything else in life, we owe some of it to the almighty government. But what really confuses people is that just because your investments go up doesn't mean that you immediately owe taxes. Capital gains are only taxed once they've been realized. Or simply put, once they've been sold. So if you have $1,000 in the stock market and it goes up to $1,100, you've made $100 in capital gains. But you don't owe the government a penny of it at that point. You've made capital gains, yes, but you haven't realized it yet. So there's no profit to be taxed. Now, once you do sell off the stock, you'll pay taxes on the $100 that you made. But there's a pretty cool and important trick that many people don't know about. The thing is, how long you hold an asset will determine how highly you're taxed on it. There's different tax rates for short-term capital gains and long-term capital gains, and you can use this to your advantage. Short-term capital gains, which is profit on an asset held less than a year, is taxed at a much higher rate than long-term capital gains, which is, you guessed it, profit on an asset held longer than a year. Be smart about this. If you've held a stock for 11 months and you're ready to sell because you've made a buttload of money on it, well, great, but you might want to consider holding on just a bit longer. By waiting until those gains become long-term, you'll get to keep a lot more of the profits, even if the price of that stock goes down a little over that last month. The long-term capital gains tax rates are one of the biggest appeals to long-term investors. And long-term investing in general is a great way to build wealth. So I hope you learned something about taxes in this video. It can seem daunting, but taking the time to learn how taxes work can make a big difference in your personal finances. And if you have any more questions, you can feel free to go ahead and leave those in the comments. Or the beauty of the 21st century is that you're one Google search away from infinite tax information. Thank you so much for watching to the end of the video. That's going to do it for today. Don't forget to like and subscribe. We're almost to 100 subscribers, so let's keep pushing. We're going to get there. Have an amazing rest of your day, and I'll see you soon.